Good morning. We are going to have this pre-recorded class. It's Saturday morning, November 9th, as I record this. I will be in training in Virginia on Wednesday, November 13th, so hence the need to record class. So this class takes the place of what we would have done in the live class that day. So let's get started and walk our way through here. First of all, we are finishing up Chapter 9. And when we're talking about what to do this week. Okay, so this week, this is what I would be saying in class on Wednesday, November 13th. We have an attendance quiz 20, which covers this recorded class from November 13th. There may also be one or two questions that relate back to Chapter 9 from Wednesday, November 6th. So if you see a question on the attendance quiz that you don't exactly recall, you might want to take a peek back at November 6th. Then the Chapter 9 homework is in my accounting lab, and that is due this Saturday, November 16th. And Sunday, November 17th, the video quiz over Chapter 10 in Blackboard, those videos in Chapter 10. So that's what's due this coming week. Now, I have emailed you all with a link for tutoring, or I will be doing that either today, Saturday, or Sunday, so check your email for the tutoring sign-up link. It also will be in the announcements for Blackboard. Haley is tutoring Tuesday, Wednesday, and Thursday this week. And we also will have tutoring during our normal class time at 7:45 on Wednesday, November 13th. So if you want to do that, you don't have to sign up for that. The room's plenty big. So do check. And also, if you sign up for tutoring, please, please, please be sure to attend tutoring if you sign up. Last week, 9 people signed up for one session and only 2 people showed up, which is really sad because then no one else could attend that session, but 7 people just simply did not show up. So you'll get an email from me if you're in that situation, because it's not a good idea to do that. So I appreciate your help there. Okay, so we are going to be covering Chapter 9. We started Chapter 9 last week, and we are going to continue to talk about liabilities. And just as a reminder, Chapter 9, we're doing Learning Objectives 1, 2, 4, and 5. We are not covering Learning Objective 3. 9 is not a bad chapter. It goes pretty quickly. So let's get started. We've got a few homework problems to do today and some questions. So let's start with this homework problem. Short exercise 9-8. We have Hunter Corporation issued 7-year bonds payable with a face amount of $125,000 when the market interest rate was 8%. Now notice they did not tell us the stated interest rate. Okay, but we'll be able to figure that out in just a minute. Assume that the accounting year of the company ends on December 31st and the bonds pay interest on January 1 and July 1. Most bonds pay semi-annual interest, so they will pay interest twice a year like this says. And we're going to write the journal entries. So for A, B, C, and D. Okay, so for A, issuance of the bonds payable at par. So where it says that we're issuing the bonds at par, so that statement right there, we issued the bonds at par, okay? What that means is then that the 8% market rate, the stated rate then is also 8%. Okay, so that's how we know what these bonds pay, because it says at par. So what we're going to do is we are going to look at the journal entry for the issuance of bonds payable at par, and what we're going to see for that is we are going to debit cash for the $125,000. If we issue $125,000 worth of bonds, the face value at par, we're getting par. So we would say that we would debit cash for $125,000, credit bonds payable for $125,000, and that is the journal entry. These 4 journal entries here, very standard journal entries. These are journal entries I would put on my reference sheet for the exam. For example, this is the journal entry to issue a bond at par. You can reason your way through the journal entry, but if that seems a little hard to do, write it down. Here's my journal entry for issuing a bond at par. I'm always going to debit cash, credit bonds payable for the face value. Okay, so that's entry A. Now, entry B, accrual of interest expense on December 31st, 2012. So we issued these bonds on July 1st. 6 months later, December 31st, it's time to issue that financial statement. We want to prepare the financial statements. So, and on the financial statements, we want it to reflect that A, that we have, well, not A, that we want to reflect that we have interest expense for the 6 months since we issued the bonds, and we also want to show that we have a liability for that interest we've incurred. So what we're going to do for entry B is we will have this entry. So I'm going to pause for a minute. Maybe you'll want to put me on pause. And then we'll talk about where those numbers each came from. Okay, first of all, to calculate our interest expense, the $125,000, that is the face value. Okay, so that's the face value. The 8%, okay, so this 8%, that's the stated rate. So we knew at par, we knew that because par meant that our stated rate was equal to our market rate. It's not the market rate, okay, but we know that the stated rate is 8% because par means the market rate equals the stated rate. And then finally, the 6 months there that we're looking at, the 6 months, this 6 here, it tells us that we issued them and we issued the bonds on July 1, and the time from July 1 to December 31 is the 6 months. Okay, so interest expense is debited for $5,000. We credit interest payable for $5,000. Interest expense goes on the income statement. That's increasing expense. Interest payable is a liability. We're increasing liabilities here. We're saying here with this entry to accrue interest expense that we have 6 months of interest expense that we need to recognize, and we need to recognize the liability for that as well. So that is entry B. That's another entry I would put on my reference sheet that here's how we accrue interest expense. Now, entry C. Entry C, we pay cash interest on January 1st, 2013. So what's happening here is we accrued it on December 31st. We prepared our financial statements, and that's why we had to do the accrual on December 31st. But we actually don't write the check till January 1st. So what happens when we write that check 1 day later? Well, what happens is we are going to be reducing the liability. We're going to eliminate the liability by debiting it for the $5,000, and then of course we're paying out cash, so we will credit cash for $5,000. So that's when we actually pay it. We wipe out the liability we just set up in entry B. Okay, so that's entry C. Okay, now let's go on to entry D. Entry D, payment of the bonds at maturity and give the date. Well, at maturity, we pay the face amount. Okay, that's the maturity amount. So that face amount, we're going to reduce our liability. We're reducing the liability. The liability is called bonds payable. We debit it. That removes the liability from our books. And then we're going to credit cash because we're spending cash. The payment of interest is a separate transaction that's not typically at maturity. So it's on the interest payment date that would have been set up already. And then as far as the date, this says these were 7-year bonds. Okay, 7-year bonds. We issued them July 31st, 2012. So those two facts combine to make our maturity date July 1st, 2019. So we had 7 years onto the original issue date. Okay, so that does it for short exercise 9-8. Let's go ahead and do a question now. Okay. True or false? Current maturities of long-term debt are reported separately from long-term liabilities. True or false? Okay, I'm going to switch now. That is true. And the reason it's true is we're talking about the current maturities. These are debt securities that we issued several years ago perhaps, and we have to pay them off in the next year. So those are no longer considered long-term liabilities. Those are now current or short-term liabilities because they are due in the short term. Okay, let's move on to another homework problem. Okay, now we have short exercise 9-11. We have a company borrowed money by issuing $3 million of 8% bonds payable at 97.5 on July 1st, 2012. The bonds are 10-year bonds and pay interest each January 1 and July 1. That's also known as semi-annual interest. So the first question says, how much cash did the company receive when it issued the bonds payable? And write the journal entry. Well, let me put up the solution, okay? And then you can put me on pause for as long as you need to write down that answer, and then I'm going to talk through where those numbers come from. Okay, so hopefully you've got that written down. So how much cash did it receive when it issued the bonds payable? Well, to answer that, we'll take the $3 million face value times 97.5. That's the percentage, so 0.975. So that's what you're seeing down here, the $3 million times the 0.975. That will give us $2,925,000. So that's the answer for this. How much cash did they receive? The answer is the $2,925,000, this number right here. Okay, so that's the answer to this first question. Now the second part of 1 is to write the journal entry. So the first thing is we're debiting cash because that's how much cash we received. The next thing I would do is I would skip down and do my bottom line. And my bottom line, this is to credit bonds payable. And this $3 million here, we're always going to credit bonds payable for the face value. Okay, so this is the face value of the bond. Okay, so right now we have a debit to cash for $2,925,000, and we have a credit to bonds payable for $3 million. The difference between those two items, the difference there, we can calculate it. If we take $2,925,000 from $3 million, the difference, that gives us this $75,000 here. That is simply the difference between our debits and our credits. Okay, the $75,000. The $75,000 is actually referred to as a discount on bonds payable. The reason I know that's a discount and not a premium is because this price that I paid is less than $100. Okay, so if it's less than $100, it's a discount. Okay, if it were greater than 100, it would be a premium, and this would actually be on the other side. But we know it has to be a debit because it's the difference between our debit of $2,925,000 and our credit of $3 million. And to make the sides even, we have to put it on the debit side. So discount, this is going to be the journal entry when we issue bonds with a discount. Okay, if we were going to issue bonds at a premium will have a credit balance, and it'll be on the opposite side. So that's how we know which one we're doing. So that's, let's see if I can make this bigger. Okay, there we go. Okay, so premium will have a credit balance instead of that discount that we have there on, yeah. So the discount will be the debit side, just like we have here. And if we had one, we don't have one here, but if we did, if this were a premium, we would see it on the other side. Okay, so that's how I would do that journal entry. That is transaction 1. Okay, so question 2, how much must they pay back at maturity? Well, payback at maturity, that's the face value, the $3 million. So that's the first answer. Pay back $3 million at maturity. And then when is maturity? Maturity, it's 10 years from the date of issuance. It issued them, we're going to add 10 years on to July 1st, 2012, giving us July 1st, 2022. So that's where those numbers are coming from. And then the third question, how much cash interest will the company pay each 6 months? Okay, so let's go into that one. The cash interest is going to be composed of a few different numbers to get to this. We're going to take the $3 million face value times the 8%, and then we're going to have to adjust for 6 months. It tells us that they pay interest each January 1 and July 1. So that means there's 6 months in each of those payments. So $3 million times 8% times 6 months out of 12 gives us $120,000 as the cash interest. Okay, so we're going to see that again in part 4. So just make note, cash interest is $120,000. That's the face value times the 8% times 6 months, half of it. It's half a year at a time. And then we go on to requirement 4. And requirement 4, I'm going to pause here and let you copy down these journal entries because this one's going to take a little while to walk through. So you want to put me on pause, write down the journal entry because then you're going to have to write down where some of this comes from. Okay, hopefully you paused, and now we're going to talk through this. First of all, first question, how much interest expense will they report every 6 months? Now notice that this is interest expense. It is not asking for cash interest. Interest expense in this case is coming from 2 sources. First of all, we have the cash interest. This $120,000 here, that is the cash interest part. So that's part of interest expense is the cash that we're spending. Okay, so this is cash. Okay, now when we issued this bond, we issued it at a discount. And why did we issue it at a discount? We issued it at a discount because if we issue it at a discount, we know it's at a discount because this 97.5 is less than 100%. Okay, so that's a less than sign. Okay, less than 100, we know it's at a discount. So if we issue something at a discount, we're saying that our bonds that pay 8%, that's less than the market rate. So to get any investor to buy our bonds, we have to give them a discount. And the amount of the discount here, the discount is right here, the $75,000. That was the discount. If you look back to entry 1, okay, entry 1 how much cash did they receive, and then the journal entry. See that journal entry, the debit we did to $75,000? Okay, this is discount, by the way, if you can't read it. Okay, there's my discount. That $75,000 in that entry 1. Then I'm going to divide it by 20 periods. And the way I get 20 periods is it's 10 years. This is a 10-year bond. Okay? And I'm going to multiply by 2 interest payments per year. And the 2 interest payments, I get one on January 1 and one I make on July 1. Okay, so 10-year bond times 2 interest payments a year will give me the 20 periods. So I take my discount, divide by 20, and what I'm going to get there then, if I take my discount and divide by 20, I'm going to get the number $3,750 is actually what I'm getting there. And so let's see if I can make that bigger. I can. Oops, too big. Maybe a little smaller. There we go. Okay, so that $3,750, that is the amount of, that is this whole thing right here. the $3,750 is this part of it. Okay, so this is the discount amortization. And discount amortization, what we're doing is we're just simply taking the $75,000 discount we gave them because our bond wasn't paying enough interest compared to market value. We're taking that $75,000, dividing it over the whole life of the bond, and taking $3,750 when we make that interest payment, and we're saying that's extra interest. We did it up front, but that still is extra interest. So we take the $3,750 plus the $120,000, and that's how we get the $123,750 as our interest expense. Okay, so what we've done so far is just answer that first question, but we have other things to do here. We have to journalize the entry for the accrual of interest on December 31st, okay? So now we're doing this accrual of interest on December 31st. So what we're going to do there is we're going to debit interest expense, and that is for that amount that we just calculated, the $123,750, okay? So we know how to get that. Interest payable, that's for the cash amount. Okay, that is for how much we're going to pay in cash. That is the stated rate times the face value times 6 months divided by 12 months. Okay, so this interest payable, we are going to have to pay the cash amount. So that was the answer for the cash amount. That's where we're getting the $120,000. Okay, and then this difference here, this $3,750, that was our discount amortization, and that will go to discount on bonds payable. This is another journal entry I would definitely put on my reference sheet. This is a discount journal entry, amortization. If it were premium, everything would work the same way, except premium would be debited in this case. Okay, so that was accrual of interest on December 31st. We're still not done with this problem. It has one more part, and it also tells us to write the journal entry for payment of interest on January 1st, 2013. So we're doing this. So what we're going to do on that date is we are paying the cash amount. We're going to debit interest payable. So we are doing this part of the journal entry right here. We're going to debit interest payable to get rid of that liability that we just set up on December 31st. So actually that's where this number is coming from. And then we're paying out cash, and that's where the $120,000 is coming from. Okay, so we are done with that question. That is, again, another very good question to illustrate lots of different concepts and to illustrate those journal entries. So that's it on short exercise 911. Now we're going to look at short exercise 915. And this is a different sort of one. We're going to be doing a balance sheet, a partial balance sheet. What we're going to do is they give us a whole bunch of accounts in the general ledger, and we're told to prepare the liability section. So what we're going to be doing is we are going to do the liability section of the balance sheet. Okay? Report total current liabilities and total liabilities altogether. Okay, so first thing we do on this one is let's get rid of the things. Let's look through our liabilities and let's figure out which things aren't even liabilities to begin with. So bonds payable, that is a liability. Equipment, is that a liability? No. So we can get rid of that. We don't even have to consider that. They're just giving us extra information. Just like real life, there's more information than we need, and part of the problem, part of the challenge is filtering out what we don't need. Current portion of bonds payable, that is a liability. Notes payable is a liability. Interest payable is a liability. Accounts payable is a liability. Discount on bonds payable, that belongs on with the liabilities. And then accounts receivable. Wait a minute, accounts receivable is not a liability, so we can get rid of that one. Okay, so now what we're going to do is we need to report the total current liabilities and the total liabilities altogether. So if you want to give this a try, I think it would be kind of interesting to do. So go ahead and on your paper write current and long-term, and then down and below what you'll have is you'll have total liability, you'll have total. And total is your current plus your long-term. So go ahead and give that a try. You might want to pause me while you do it, and then we'll walk through it. Okay, so again, This was our data at the top of the screen. Let me just cross off those assets that do not belong on our liability section. Okay, so current liabilities. The first current liability is always going to be accounts payable in virtually every case I can think of. So we have current liabilities, accounts payable, current portion of bonds payable, that's another good one, and then interest payable. The reason we know interest payable is a current liability is this date right here, March 1st. We're preparing our financial statements, are being prepared as of December. Our financial statements are being prepared as of December, let's see, balance sheet date is December 31st, 2012. Okay, so our balance sheet date is December 31st, 2012. That's less than 6 months different from that, so it has to be there too. So we're going to put all those amounts down here, and then we'll add them up, and we'll get our total current liabilities of $90,700. Okay, so that's current liabilities. Now let's move on to the long-term liability section. Okay, so again, long-term liabilities, get rid of equipment, get rid of accounts receivable, since those are both assets. Okay, long-term liabilities, we have notes payable, bonds payable. Something to note, this discount on bonds payable, that gets subtracted here, okay, to get our net bonds payable. And then there's a little note to make that if this were a premium, okay, premium to bonds payable. Okay, so premiums would increase the amount. Here we go. Okay, and maybe I should make that just a little bigger. Okay, so just a note, premiums get added to bonds payable. Discounts get subtracted. So it's just another note I would make. So then what we're going to do is we are going to we have to add up our totals now. So what we're going to be doing, we'll add the 90,700, the 125, and the 365, and what we get is the 579,450. And that is our total liabilities here. Okay. Now, just as a note, this premiums get added to bonds payable has nothing to do with this homework exercise. This is something, this is just a hint for other problems. Just premiums get added to bonds payable. But we don't have a premium here. I was just pointing out the difference between the two. Okay, so let's do some questions now. First one, true or false? The account discount on bonds payable increases a company's liabilities. True or false? The answer is false. The discount on bonds payable, this actually discount on bonds payable decreases amount of liabilities reported. Okay, so in this particular case, discount on bonds payable decreases the amount of liabilities reported. So this is false. Okay. Okay, if the market interest rate is greater than the stated interest rate, the bonds will sell at a discount. Is that true or false? Should be able to answer this one, so pause it, look at it, read it, and take a stab at it. And this is true if the market interest rate is greater than the stated interest rate. So what we're saying is if we're the bond issuer, we're paying, say for example, 7%. The market's paying 10%. No one would invest in our bond unless we sell it at a discount. So this one is true. Okay, have another one here. Read this one carefully. I do want you to try this one. If $120,000 face value bonds are issued at 104, the proceeds received will be $104,000. True or false? So I want you to think carefully about this. Pause, make sure you have an answer, and then proceed. That is false. How'd you do? Let's talk about why it's false in case you said true. This one's very easy. You have to really watch the wording. 120,000 face value times 104% is actually 124,800. Those are the proceeds. So you can't just say 104,000. Okay, so you have to pay attention to the face value. So that one is false. Another one, if the interest rate on a bond is 8%, so the stated interest rate on the bond is 8% and the market interest rate is 7%, the bond will be issued at a price above the par value of the bond. True or false? So again, think about it. Market's paying 7%, our bond is paying 8%. Will that bond be issued at a price above the par value, at par value, or below? This is a premium. This is true. This is a premium situation. So when we talk about this situation, when we look at this kind of situation, this is known as a premium, where the market interest rate is lower than the stated interest rate of the bond. Now, notice it doesn't say the stated interest rate, but it tells us the interest rate on bond. That's implying that it is the stated interest rate. Okay, let's do another one. If the market interest rate is 6%, a $10,000, 7%, 5-year bond that pays interest semi-annually would sell at an amount A, less than face value, B, equal to face value, C, greater than face value, or D, the stated value. Okay, and the answer is greater than face value. And again, the reason is the market's paying 6%. This bond is paying more than that. Investors would be paying a premium for it. So that's when we have a greater than face value situation or a premium situation. Okay, now, Chapter 10, and Chapter 10 is originally what I had on the schedule for November 13th, but as I thought about it, I think it really makes sense to do most of Chapter 10 next week in class on November 18th. We'll have time to get through it, but here's an overview. We just, in Chapter 9, talked about liabilities. In Chapter 10, we're moving down the balance sheet now to the equity section, and the equity section will be talking about all 4 learning objectives in the chapter, but the chapter is not bad. You know, those first 3 chapters in the book, chapters 1, 2, and 3, those were some pretty heavy lifting. There's a lot of content, a lot of fundamental principles in those, and they take a long time to get through. Now, these chapters that we're in now, a lot less content, very much easier to get through, and that's why we can zip through them. We're going to be talking next week, stockholders' equity. Well, you'll be watching the videos before Sunday night or before stockholders' equity, the features of the corporation, issuing stock, treasury stock. Treasury stock is a company's own stock that it buys back. It's issued it, and then it goes out to the market and buys it back for various reasons. And then finally, retained earnings, stock dividends, cash dividends, and stock splits. So that's in Chapter 10, and we're going to be covering that in the videos Sunday night and then in class on Monday, November 18th. And then we move on to what's due this week. what's due this week? Again, attendance quiz 20, that covers this recorded class. It could possibly cover some questions we did on Wednesday, November 6th as well, because we did start Chapter 9 then. It also covers Saturday, also Chapter 9 homework is due November 16th. And Sunday, November 17th, the Chapter 10 quiz, video quiz is due, video quiz 21, and that's over the Chapter 10 videos in Blackboard. Okay, so it felt really weird to not have class this coming week. We had Veterans Day on Monday, November 11th, and then Wednesday, November 13th, I am at training in Virginia. So that's always interesting. It's always great to get additional training. I don't think you can ever quit learning. And so I'm looking forward to seeing you on Monday, November 18th. I would urge you to come to class because remember, there are pop quizzes and there is a very high chance that there will be a pop quiz on Monday, November 18th. I'm not promising it, but I would urge you to come to class, and absolutely to come to class every day. We're down to the home stretch now. We have Monday the 18th, Wednesday the 20th, Monday the 25th, and then 1 week after Thanksgiving, and that pretty much does it. So have a good week, and I will see you on Monday, November 18th.